In just 60 days, China dumped over $200 billion worth of U.S. Treasury bonds, the fastest sell-off ever recorded. Wall Street is shaking, mortgage rates are spiking, and Washington is scrambling to contain the damage. What started as a tariff war is now spiraling into a financial crisis. Is America's economy heading for a crash? Or is this just the first tremor before the real quake? Stay with us as we break down the shocking moves reshaping the future. The shock came in April 2025 when President Trump raised tariffs on China to 125%. Within weeks, China made a bold move. They slashed their U.S. Treasury bond holdings by over $100 billion, with total reductions now nearing $200 billion over a few months. According to the U.S. Treasury Department, China's holdings dropped below $700 billion, the lowest level since 2009. Financial analysts from JP Chase called it a financial warning shot, not just a threat. By selling U.S. Treasuries, China directly attacked one of America's most critical financial pillars. When Treasuries flood the market, their prices fall, which makes bond yields rise. Higher yields mean the U.S. government must pay more to borrow money, and that spills over into everything: mortgage rates, car loans, business borrowing. The impact was immediate. Treasury auctions struggled, demand weakened, and interest rates across the economy ticked higher. But China's sell-off wasn't loud. It was quiet and methodical, happening through state-owned banks and discrete trades. Some reports even suggest Beijing ordered institutions to trim dollar exposure aggressively. This slow, steady unloading kept Wall Street nervous. And unlike a sudden crash, it gave China more control, damaging the U.S. without hurting itself as badly. It's clear this was not a bluff. It was the opening move in a much bigger financial chess game. The impact of China's bond sell-off hit Wall Street almost immediately. As Treasury bond prices fell, yields surged higher, and that sent shockwaves through the entire financial system. In just 3 weeks, the S&P 500 dropped by nearly 8%, wiping out over $2 trillion in market value. According to Bloomberg, banking giants like JP Chase and Bank of America lost over $180 billion combined in stock value by mid-May 2025. Investors rushed to safer assets, but options were shrinking fast. The housing market felt the pain too. Mortgage rates, which hovered around 6.2% earlier this year, suddenly jumped to 7.8%, the highest since 2000, according to Freddie Mac's latest survey. Mortgage Bankers Association data shows a 30% crash in new home loan applications within a month. For millions of Americans hoping to buy homes this spring, the dream just got much more expensive, or simply out of reach. The credit markets, usually calm, also started flashing warning signs. Corporate bond spreads widened sharply, making it harder and costlier for businesses to borrow money. Even tech stocks, usually resilient, tumbled as fears of a broader recession grew louder. CNBC reported a 12% drop in tech-heavy Nasdaq stocks over just 2 weeks. As China continued to quietly offload bonds, every corner of Wall Street started feeling the tremors. And experts warn this could just be the beginning. The tremors from China's bond sell-off didn't stay inside U.S. borders. Other major holders of U.S. debt started quietly backing away too. Japan, the second largest holder of American treasuries, cut its holdings by $90 billion in April alone, according to Nikkei Asia. That's Japan's biggest single-month reduction since 2011. Meanwhile, Treasury Department reports show foreign participation in U.S. bond auctions has fallen below 38%, the lowest level in 25 years. European investors are getting nervous too. Bank of America analysts warn that trust in U.S. Treasuries as a safe haven is slipping fast. Instead, countries like Germany and France are shifting more reserves into euro-backed bonds and gold. The International Monetary Fund's April report even sounded the alarm. Confidence in the U.S. financial leadership is visibly eroding among global markets. This shift isn't just numbers on a screen. When fewer foreign buyers show up at U.S. auctions, it forces Washington to offer even higher interest rates to attract money. And that spills over into higher costs for everything from mortgages to business loans. Emerging markets, which often depend on dollar stability, are also feeling the heat. Currencies across Africa, Asia, and South America are wobbling as investors pull back. The world economy is entering dangerous new territory, and the fallout is just getting started. As the financial chaos grew, the political cracks inside Washington became impossible to hide. President Trump stayed defiant, repeating that America will win the trade war. But behind closed doors, his own advisors were deeply divided. Some tariff hawks pushed for even tougher action against China, while economic advisors and Wall Street insiders warned that the bond sell-off could tip the U.S. into a recession. According to CNN, emergency meetings inside the White House turned heated by late April. Senators from both parties began raising alarms. Senate Banking Committee hearings opened in early May to investigate how the tariffs and China's sell-off were impacting American families. Even Republican allies started urging Trump to rethink the strategy, with some warning that rising mortgage rates and falling 401k values could cost the GOP dearly in the 2026 elections. Meanwhile, the White House quietly announced a 90-day pause on new tariffs, but only for Europe and U.S. allies, not China. Analysts called it a sign of panic, a desperate move to stabilize relationships with other trading partners. President Biden criticized Trump sharply, saying, "You can't tariff your way out of a debt crisis." Inside Washington, the mood was shifting fast, and political survival was now just as much at stake as economic recovery. China's bond sell-off isn't just a short-term retaliation, it's part of a long-term master plan. Instead of triggering a full-blown collapse overnight, Beijing is slowly bleeding the U.S. financial system. According to Reuters, China has expanded digital yuan projects across Africa and Southeast Asia, locking in new trading partners outside the dollar system. At the same time, BRICS countries are ramping up currency swaps and trade deals in local currencies, cutting their reliance on the U.S. dollar. Oxford economics analysts describe China's strategy as quietly rewiring global finance without setting off alarms. It's death by 1,000 cuts. Sell a little debt here, create a digital bridge there, form new trade blocs elsewhere. Over time, this weakens America's financial dominance without starting a direct confrontation. Chinese banks are also quietly reducing their dollar exposure, building reserves in gold, euros, and other assets. The People's Bank of China announced in April a 10% increase in gold holdings, their biggest monthly jump in 5 years. Meanwhile, major Belt and Road countries are signing new deals to settle trade in digital yuan. This is not just a trade war anymore. It's a slow but deliberate campaign to erode the very foundation of America's economic power. As China continues unloading U.S. treasuries and global trust in American debt weakens, cracks are starting to widen across the financial system. Corporate bond markets are tightening fast, with yields on lower-rated bonds, known as junk bonds, spiking past 10%, according to Bloomberg's May 2025 update. This makes it much harder and more expensive for businesses to borrow, slowing growth across the economy. Fidelity Investments also reported that the average American 401k retirement portfolio has already lost about 12% in value since April. For millions of families, their financial future is suddenly looking a lot more uncertain. Meanwhile, home sales are plunging as mortgage rates stay above 7.5%, locking many buyers out of the market. Top economists from UBS and Morgan Stanley are now warning that if foreign Treasury sell-offs continue through the summer, the U.S. could be pushed into a recession by early 2026. Some are even comparing the early warning signs to the 2008 crash, but triggered this time by a sovereign debt crisis, not subprime mortgages. The Federal Reserve is now under pressure to cut interest rates later this year just to calm the chaos. But will that be enough? Or is a full-blown economic downturn already baked in? As the financial pressure mounted, Washington rushed to act. In May 2025, the U.S. Treasury Department announced an emergency bond buyback program aiming to stabilize collapsing Treasury prices. According to the Wall Street Journal, the government plans to repurchase nearly $300 billion worth of longer-term bonds by the end of summer. At the same time, the Federal Reserve stepped in, injecting $500 billion in liquidity into the banking system to prevent a credit freeze. But even with these actions, cracks are still forming. Yields on 10-year treasuries remain stubbornly high, and demand from private investors isn't strong enough to replace the missing foreign buyers. Meanwhile, the Fed signaled that it may cut interest rates later in 2025 if market stress continues, hoping to ease the strain on borrowing and spending. In the background, G7 finance ministers scheduled an emergency summit to coordinate responses to the growing U.S. debt crisis. Leaks from Bloomberg suggest Fed officials privately describe the situation as throwing sandbags against a financial tsunami. While Washington's moves may slow the bleeding, they don't fix the deeper problem. Trust in U.S. debt is shaking globally. And if confidence keeps slipping, the tools the U.S. is using today may not be enough to stop the next wave. The financial fuse has been lit, and the next explosion could be closer than we think. Subscribe now for real-time updates, like the video, share it with others, and drop your thoughts in the comments. Your voice matters here.